When you leave your job, you get to take your pension with you if you want to. Now, don't get too excited. It's not free money. It's still meant to be a source of income in retirement, and the government is going to make sure it stays that way. There are rules and regulations about what to do with the pension and how to do things with the pension depending on, the jurisdiction of the pension itself, whether that's provincially or federally. When you leave your employer, you have a few different options of what you can do. Sometimes you don't transfer. You leave the pension with the company as it is, because the payment that they're going to give you in retirement sounds pretty good. Generally, an employer will give you a deadline on making a choice on what to do with your pension. They do their valuations of the pension, and then you have a certain amount of time to, make that choice. If you choose to do nothing and don't make a choice, then you wind up keeping your pension there, indefinitely, and it'll start paying out to you at whatever age they're going to allow, whether it's 50 or 55, and then, that's it. It happens. The next option, you might be able to take your previous pension and transfer it into your new pension with your new employer. Things have to match, and there's a process for that, but it is something that you will be given as an option. The next option from there is to transfer it to your own locked-in retirement account. So in that case, you transfer it to your own self. You do then take on the responsibility for the risk and the returns and the investing, but you 100% own the asset, and you 100% own the ability for 100% spousal transfer. So if you were to pass away, you transfer 100% of that asset to a spouse. And of course, one of the final most common options is transferring it into your own RSPs. One of the benefits of transferring the investment to your own locked-in retirement account is that, as I mentioned, you do own the asset, but then you do also have flexibility with the payments. And from a planner's perspective, when we're looking at tax-efficient income in retirement, if you have a choice on whether to take lesser or more as opposed to a single benefit, that can be a really excellent choice to make, because that might help you tax-wise. It might, give you a little bit more flexibility if things come up in retirement, you need a little bit of extra money. While it's not always the choice for everybody, it does allow for a lot more flexibility. Each pension is different, but for the most part, we expect that there's going to be a locked-in portion, and then there's going to be a cash portion. With that cash portion, I really enjoy the secret trick of being able to request approval from the government to use that cash portion to put into your own RSPs. That way, you can keep that money in your pension for your future self, and your current self doesn't have the taxable event and the added income from withdrawing that cash portion. In some cases, you left your job willingly, but in some cases people don't, and they're packaged out for whatever reason, and that brings a whole new level of emotion into play, which can really make it difficult to figure out what choice that you want to make. And that's really where we come in, and we're really able to help out a lot with this, because it's a matter of math, it's a matter of flexibility, and it's a matter of streamlined and tax-efficient income in retirement. And this is where we're able to help, go through the emotional aspects of it and come out the other end and say, this is a really good option. Everybody's options are entirely different for their specific circumstances. So we're not always just going to lean toward one or the other. It's really about you and what you need.